Welcome. Everyone. I think most of you know me. My name's Tom McCarthy. I'm the founder of McCarthy and Cox. And we've done a number of these webinars through the years. Brad's been our featured speaker many times. Brad comes to us from Commonwealth. Brad, I want to make sure I give you due respect here. You're a managing principal and you're now your title is Chief Investment Officer. That's correct, right?
That's correct.
What does that mean for our folks here today?
What that means is basically I am in charge of Commonwealth's investment groups, which is about over $200 billion of money for hundreds of thousands of families nationwide. That's something I don't take lightly. In fact, sometimes I have trouble sleeping at night simply because, worrying. We have a lot of responsibility working with our advisors in the field, of whom Tom and Jim and their team are among the best. So you should be very happy with where you are. As a managing that's kind of what I do. As a managing principal, I also help run the company as a whole. And I am pleased to say that we've now won 9 J.D. Power Awards in a row. So I think we're doing okay. But again, it's a big responsibility because you all matter. And that's why I'm here.
Well, we always look forward to hearing from you. We appreciate your perspective. I think that anyone who's tuned in today and is looking for a political diatribe on one side or the other is going to be disappointed. But let's talk a little bit about the election. I think in our corner of the world, a lot of folks were, before last week, were pretty excited, thinking there was going to be a big wave, a big change in Washington. As it turns out, it now appears that the Senate will remain Democratic hands with 50 senators at this point. So the election in Georgia, while it may be pivotal, won't necessarily change the outcome dramatically. And the House looks like it's going to probably end up slightly Republican, but did not have this big wave of change that many people had expected. So what does that all mean for us as investors, as many of us who are retired, thinking ahead to the next couple of years? What does this Congress going to look like, and what does it mean for us?
That's a great question, Tom. And that's obviously, what we need to think about. The way I express it is simply this. I got 2 hats here. I've got my citizen hat, and there I certainly have opinions and thoughts, but nobody cares about that, at least in this context. And then I have my economist and investor hat. And when I put that on, I put the politics and I put politics and everything aside and just say, okay, what does this mean for our money? So what it means for our money is probably very good. And the reason I say that is this, because if you go back and if you look at either the market or if you look at the growth of the economy over time and you take the dates off, you don't know what the government was doing. You don't know who was in the White House. You don't know who controlled Congress. And the reason for that is simple. Washington can have an effect. We all know that. But at the end of the day, at the state level, at the local level, at the company level, you're betting on American entrepreneurs and American workers. And there's simply not too much that the government can do to derail that over time. So from that perspective, it doesn't matter. And even from and by the way, thank goodness for that, because we wouldn't be where we were if it wasn't, if Washington was in charge, we wouldn't be as well off as we are with American workers and entrepreneurs in charge. So what do I mean when I say we're actually in pretty good shape? Well, there's only so much Washington can do for good, and there's quite a bit they can do for bad. So what a very tightly balanced Congress means is they can't do much of anything. And because there's more bad they can do than good, that actually means they're going to do less bad stuff. So net, we're ahead. So so I'm okay with the divided Congress. And the other good thing about this, if they do something, it's likely to have very broad support across both parties. And those are the sort of things we actually want them to be doing if everybody agrees on it. So in many respects, it's not ideal, but it's probably as good as we were going to get. And actually, if you go back and you look at market returns over time, divided Congresses have generally tended to be among the best returns. So on the whole, I'm encouraged by the results.
Well, I think a lot of us may take a little sigh of relief in hearing that. Uh, we've all been concerned about just the costs of everything. Congress passed what they called the Inflation Reduction Act, which I think is an interesting title. Um, are are there things Congress we can expect from Congress that might help with this inflationary situation, or is it simply waiting on the Federal Reserve to get everything back in order? What does that mean for us?
Well, I think that Congress is going to help, but largely through the things they're not going to do, per my prior discussion. When you look at what Congress does, Congress has the power of the purse. They're the ones who spend the money. And there's two ways they can do that. Effectively, they can spend more money or they can cut taxes, which means they're spending money and they're taking less out. Either one is what's called a fiscal stimulus. And a fiscal stimulus basically heats up the economy and pumps up inflation. So consequently, if you have a Congress that's not going to be spending money or not going to be cutting taxes, that means the fiscal contribution to inflation is going away. And in fact, we've seen that as the deficit has gone down in the aftermath of the pandemic. So what we're seeing with inflation right now is we're seeing the after effects of a lot of spending that has come through over the past 4 to 6 years, certainly since the pandemic. And I'm not going to get into the Inflation Reduction Act. I will agree with you that probably doesn't pass the truth in advertising screen. I get it, Tom. But because of all that, we're not going to be seeing that going forward. And a lot of the money that was authorized in the past 2 to 4 years is going to be is going to run off. The other, from the fiscal component, I think you're going to see inflation start to fade. Now, the other interesting thing here is, and this may be more detailed than you want, I don't know, but we're already starting to see other components of inflation start to roll over. Energy prices are rolling over. This is what I talked about at our national conference. Labor costs are starting to come down, even though the labor market remains very tight. Food prices are moderating. And the thing is, one of the biggest contributors to inflation outside of food and energy, which are coming down, is housing. And that's starting to come down as too. And that's a direct result of the Fed's policies. So when you look at it, the Fed's policies are working. We're seeing inflation starting to come down in pretty much all of the components. I think we're going to see that continue to improve through this year and next. And it'll probably be close to something like normal towards the end of next year. In other words, what the Fed is doing, what Congress is not doing, it's working. And things will continue to get better.
So, Brad, do you think it's too optimistic to think that prices will actually go back to where they were? Are we going to have to accept these new higher levels and that'll become the new normal and we just won't see increases on top of them?
That's exactly right. Prices are not going down as a general thing. Now, that said, we could see prices drop in individual areas. In fact, if you look at goods, which are things we buy, they actually did go down last month for the first time in a long time. If you look at energy prices, they came down sharply. And if you look at history, energy prices tend to cap out at about $100 a barrel for oil. So there we are going back to something like we were pre-pandemic. And we're seeing other things as well. In general, I don't expect prices to go back, but certain components, especially things like energy, have already gone back. So on balance, I think it's going to be better than we think, but not as good as we would like.
Sure. I know the Federal Reserve is supposed to be apolitical. I don't know if this election tilts them or changes their perspective, but we do know that they've been raising interest rates and they've said they're going to raise them again by some measure, maybe 0.5% at the next meeting, which is slightly less than the past. How long should we expect between a rate hike and actually seeing the impact of that cost change work its way through the economy?
Historically, what has happened, it's been about 12 to 18 months for the Fed's rate hikes to work their way through the economy. And as I say, we've already started to see that effect, especially in housing. We're seeing it in other areas as well. but it's going to keep hitting the economy, and it's going to get worse probably towards the end of next year. That's when it's going to be about the worst, would be my guess. And that's why, as I say, if we're looking at maybe a recession next year, it's probably coming in the second half of next year. So, we're certainly going to see continued damage. That, after all, is what the Fed is trying to do. And even if we do get inflation down, we're still going to have to deal with all of that lagged negative influence. So a recession sometime next year is quite possible. But given the rest of what's going on, even if we get a recession, I don't think it's going to be that bad.
If we do have a recession, Brad, just from your perspective, how long do they last and how bad does it get?
Tom, if you think about it, the last real recession we had was in 2008. And people think of that, but the thing is, that wasn't a recession. That was a depression. That was terrible. So that's one end of where it could end up. And it's not going there. I don't think it's going there. The other end of that might be, we had 2 quarters of negative growth this year. So, and people say, well, that meets the definition of a recession. Well, it doesn't, but it kind of does. So let's call that a recession, right? But other than the statistics, nobody really noticed. And I think those two give us a framework to understand this, because why was it so bad in 2008? And why did nobody really notice this year? And it all comes down to employment. If everybody, a recession to most people is, I lose my job. That's what people are thinking. Actually, a depression is when I lose my job. A recession is when you lose your job. But anyway you look at it, it all comes down to jobs. And the thing is, right now, the past 2 quarters, we saw job growth continue. We saw everybody who wanted a job. I know that's not the case everywhere, but at a national level, anybody who wants to get a job, just looking at the numbers, can get a job. And right now we have 10 million job openings. The highest we ever saw before the pandemic was 6 million. So we've got the 6 million from before the pandemic, plus we've got another 4 million. The jobs market is not going to get that weak. And even if we get a recession, it's not going to be driven by people losing their jobs. It's going to be driven by housing prices. It's going to be driven by housing construction. It's going to be driven by things that aren't really affecting the average person. So it won't feel like a recession. And that's why I say it won't be that bad. Because when that many people are working and when there's that many jobs out there, it's hard to get a bad recession.
One of the things that we hear from our clients is just a concern that, in the past, we built these diversified portfolios for them. We've had stocks and bonds. We've done U.S. and international. We have some alternative strategies thrown in and some hedges. But frankly, this year, other than cash, it was a tough year. Maybe energy would have bailed us out a little. The front page of the Wall Street Journal talking about have it right here, a classic strategy for investors falls apart. The old 60-40 portfolios declared dead on arrival. I don't know if Congress could do anything about that, but I'm curious about, what do we do about that? Is it really dead?
No, it's not dead. And I'll tell you why. Because when you look at last year, obviously it's a disaster. It's terrible. You can't get away from that. But the question looking forward is not, was it a tough year? Of course it was. The question is, why was it a tough year? And to think about that, you need to look at a longer time frame than just, oh my God, I lost money. Because why did you lose money? You lost money because interest rates went up. It's really that simple. When interest rates go up, the value of bonds goes down. I can spend 20 minutes talking about the math if you want, but maybe not. Same thing with stocks. When interest rates go up, stocks go down. So you gave some money back in the past year. But why did you give the money back? Because you made a ton of money in the years before when interest rates were going down. You made a lot of money on your bonds, and then you gave some of it back. You made a lot of money on your stocks. Just looking at valuation, stocks went from being worth about 16 times next year's earnings up to about 22 times next year's earnings. And we thought we were all geniuses. We were all rich. Well, guess what? When interest rates went back up, the valuations went down to about 16 times again, which is where we are right now. And they will continue to go up and go down. But the reality is the companies are going to continue to make money. Your investment will continue to grow. So, why did this happen? Because interest rates were going up. Well, interest rates are now at about the level they're probably going to be for the next 10 years. If you look at where the 10-year yield is, so we're not going to get the tailwind or the headwind from the interest rates going forward. So where we are right now, we're in pretty good shape. You made a lot of money, you lost some of it, you're still in pretty good shape. Terrible year, but over time, not so bad. The other thing that's important here is when we look at the higher interest rates, and remember, this cost us some money, but now you can get 4 to 5% risk-free in treasury bonds. A lot of people were saying to me, boy, I would literally kill somebody for 4 to 5% risk-free returns. You don't have to kill anybody anymore. Now you got treasuries. And going forward, that's a godsend, especially for people who are in the retirement years.
Yeah, we've been reminding a lot of our clients about just how bonds work and what the yield to maturity is now that they've sold off. And it really is pretty compelling on both the government and the corporate side. Are there any areas or industries that you would be concerned about in this divided Congress? If they're not going to be able to do much about anything without a broad consensus, are there any sectors or areas that people ought to be concerned about?
I think there are more opportunities than there are areas to be concerned about. I mean, just looking at what's going on, I think energy, you hear a lot about, well, they're not letting people build pipelines, they're not letting people drill. You hear a lot about that, but the truth is that means oil prices and energy prices are going to be higher. That's going to be better for energy companies. And in fact, what's interesting is, for all the political angle in this, what seems to be driving a lot of the lack of supply in the US is because companies don't want to drill. Because Wall Street has said, we're not willing to pay you to drill. We like the high oil prices. We want to keep making money. We don't want to drill and drive prices down again. So I think energy still has a tailwind behind it. I would probably be, if you're looking for something to be concerned about, I would probably be financials. Because some of the things that have blown up recently, the FTX exchange.
The Bitcoin business.
Exactly.
Cryptocurrency.
Exactly. That has raised attention in Washington on what's going on in that sector. So I think financials are going to get some more, especially now that the Democrats have retained control of the Senate. Financials are going to be getting some more attention. Also, I think tech is going to be getting more attention because they're starting to lay people off. Amazon, for example, there's discussion they're going to lay off about 10,000 people. Elon Musk is now picking a fight with one of the leading Democratic senators. So I think tech is running into tech is in a position, they've grown to the sky and they've benefited enormously in terms of valuations from declining interest rates. If interest rates don't decline, that eliminates a major tailwind. So I think tech is another area. We're seeing a shift in general from growth to value, and I don't expect that to change in the near-term future.
Can you explain what that means for the average person? When you talk about a value stock, I think we know what growth is, but what's value mean?
Value are companies that actually make money. Value are companies that will commit to sending you back money as dividend payments. Value is a company that is expected to grow at a reasonable rate. It's not that they don't grow, it's that they're not growing at 30, 40, 50% a year. In other words, most of what you're buying right now when you buy a value stock is the company as it is right now, not the company as it is going to be 5 years from now or 10 years from now. You're buying something real. You're not buying hope and dreams. Now, you can do very well buying hope and dreams if everybody is hoping and dreaming, but that doesn't always work. which is why I say right now, I'm more in favor of buying businesses that are actually working and making money today.
Sure. We've both been in this business a few years, and I can remember a time when value stocks were the day, but that's been probably 8 to 10 years ago. And it's kind of one of those reversion to the means. It at some point it flips. So what I'm hearing you say is you think that is an opportunity going forward.
That's exactly right, Tom. You've seen this movie before. The growth outperforms, the value outperforms, the growth outperforms, and hey, here we are on at the opening credits again.
Brad, I'm just curious. A couple of years ago, you wrote a book, and we all read it, and about crash proofing your portfolio. I'm just curious, how did that work out for you this year? And is there a version 2 in the works to tweak or amend it, or is it still a pretty good portfolio idea?
It's still a very good portfolio idea. It's because obviously I keep an eye on it. And in fact, I manage a very significant part of my own portfolio using those ideas. So I'm actually walking the walk here. And it's not making money. It's down about 5 or 6% the last time I checked. And I'm okay with that because everything else is down about, I think a 60-40 is down about 15 right now. So I'm still okay with that.
Sure.
We do have a 10 asset version of that portfolio that we've seeded and is doing actually even better than the 3 assets. So I'm probably going to be moving a lot of the money that I have in the 3 asset into the 10 asset. Again, this is something that's going to underperform when times are good, very likely. And we hope it outperforms when times are bad. And it has done just that.
Well, what's the title of your books? I know some of our people watching this will probably be curious now that I asked you that.
Crash Test Investing. It's available on Amazon, and I got to be honest with you, it's the best book I've ever written.
Yeah. So how many other books have you actually written, Brad?
Well, I'll have to get back to you on that, Tom. Oh yeah, 0.
No. Well, we do appreciate your candor, and I know that we have just a few minutes left here, but if anyone does have a question they'd like us to put to Brad, we're not allowed to use the chat button because of compliance reasons, but if you email us at info@mccarthyandcox.com, I'll be glad to put that to you. I did have one client call this morning. As you know, Honda is a big presence here in Marysville. It drives this part of the state of Ohio economy, no pun intended. There's this rush to electric vehicles, but Honda's claim to fame is one of the most durable, dependable internal combustion engines a person could ever want to have. How quickly do you see this paradigm shifting to electric vehicles, and how much of this is being driven by public policy and politics versus just the economy?
Well, looking back, I think there's no doubt that this got its start because of policy, because of public policy. This is not something that would have happened just by itself, at least not to the scale of what we're seeing. But at the same time, now that it has gotten started, it very definitely has a momentum of its own. And the argument behind that is, first of all, it's much cheaper to operate an electric vehicle. You're going to save, numbers I've seen, you save nowadays $100 a month in gasoline. That's material for the average family. And then on top of that, it's actually much cheaper to maintain. Yeah, Honda has probably the best internal combustion engines, but they're still tougher to maintain than they are an electric motor. You don't have to do oil changes on an electric motor. So, you might save a couple $100 a year there. So what you're seeing is a real shift in how people make decisions, not because it's environmental, but because it's cheaper. And that's when adoption really starts to take off, when the average person can actually see the benefits. So that said, we're still early days. I think it's probably a 10 to 15 to 20 year process, but we are seeing things ramp up. And that's something that I expect to continue.
Do you have anything for me, Cassandra? Well, Brad, we're right at 12:27. We asked for a half an hour and you filled it as I expected you would. Any closing thoughts or conclusions you'd like to share with us?
I think the biggest thing is this. There's been a lot of bad stuff that's happened. Yeah, I get my investment statements too. I get it. I read the headlines, and there's this sense on both sides that the country is breaking up and coming apart and that we don't have a future. Now, obviously, I have my own political opinions, but as an economist, as somebody whose job it is to make you money, I still feel really good about what's going on. Do we have problems? Of course we do. Do we have things that could go wrong? Of course we do. But we have overcome every single obstacle, and we're going to keep doing that. I am never going to bet against the United States, not because I'm an American, but because I can look at the numbers. I can see that we have the only major economy with a growing population. I can see that we are the only major economy that is fully food self-sufficient. I can see we're the only major economy that's energy self-sufficient, or we could be. I can see that if we look at our neighbors, I'm not too worried about Canada and Mexico invading us. We live in the best place in the world. And if our government is occasionally made up of idiots, and I would argue our government is usually made up of idiots, that's never stopped us from moving ahead going before, and it's not going to stop us now. Read the headlines, but remember, we're going to be fine.
Thanks, Brad. I really appreciate you taking time. I know you're just coming off this conference. You've got a lot of demands on your time. I appreciate you spending a half an hour with us today. And I also want to just tell everyone who's on this call, thank you. I mean, we're going into that season when we pause and we say thanks for all the blessings in our lives, and serving the community we serve is an incredible blessing. Brad, this last week, we put a challenge out to our community. We said we would match dollar for dollar the money that was raised here locally, up to $10,000 to benefit the hurricane relief efforts in South Florida. We raised, in addition to our $10,000, almost $45,000. So $54,000 in just a little over a week was raised, and it's all going directly to direct services for people in South Florida. So I can't tell you how humbled we are around here that we have the privilege to serve such incredible people. And we really appreciate your help in doing that. So to everyone on this call, we wish you the best of Thanksgivings, a time with your family. And don't forget to remember why we give thanks. And the good Lord has given us such a great opportunity here. And we look forward to seeing you over the Christmas season. And Brad, all the best to you and your family. We hope you have a great holiday as well. Thank you.
And you and yours.
Bye-bye.